our Village South property here, it's a 100,000 square foot retail center here. Across the board, we're up 20-30%. And so what was underwritten at a 12% cash on cash, this next quarter, July 1, we'll be paying 25%.
Wow. That's insane.
And by the end of the year, we may be paying 30%. And remember, that's the return to the investor.
That's just operational cash flow.
That's after our split. We're splitting the cash flow, and we're taking 25% and we're giving the investor 75%. And the 75% of the cash flow is still 30%.
Wow.
And so literally they could have their money back in 3 years. Of course, we've been delivering those returns now for 5 years. So most of them have close to their money back already.
All right, what is up? Welcome back to How to Invest in Commercial Real Estate. I am Braden, and I'm here with Brian and Joel. And today it's all about just the massive opportunity that's out there in commercial real estate. I mean, it's literally endless when you think about commercial real estate and everything it involves. You know, from land to apartment complexes, shopping centers, industrial. I mean, commercial real estate is all around you. You see it every day, and somebody owns it, and they're getting the advantage of it. And it's been a secret for a long time. And, you know, it's kind of the basis of the podcast is just breaking down how much opportunity is out there and how easy it can be to go and get it.
You know, when I first started getting into commercial real estate, I couldn't drive by a building without asking myself, this little retail shopping center, how much is someone making on this multifamily deal? How much are they making on that? But the thing is, everybody is making money on every single building that you're driving by. And right now what we're seeing with money getting dumped into the market is the money flow into commercial real estate is really driving up prices and value, especially in multifamily. And we're having a little bit of a harder time finding deals to deliver what are traditionally really high cash on cash returns to our investors. Even though we've got several deals going with both Criterion and Precision, we're still trying to hit 11, 12, 13% cash on cash. And the deals we pitched so far are still doing that, but they're getting harder and harder to find.
Yeah, it's amazing to me that you can still do that in real estate. I keep waiting for it to go away. I think we've said on this podcast before, traditionally I've always invested until now in stocks. And so people think it's great if you buy a stock that's paying a dividend of 2% or something and averages 9% return a year. They think that's fantastic. And here I am, I'm shooting for, double digit cash on cash and maybe somewhere around 20% IRR. And the compounding on that is just unbelievable.
Yeah, let's dig in there because, the past 18 months has been, kind of a shit show. You have COVID, and even with people that are traditionally investing in the stock market or just whatever they traditionally invest in outside of real estate, COVID hits and you're going to completely reevaluate that. You may have had, a big sell-off. It may have gone down. Now it's, back up and people have all this money and, crypto, and there's Dogecoin, there's AMC, there's GameStop, there's all these stupid things that people are doing with their money. But now more than ever, you're seeing so much buying power on the sidelines, and man, it is acting. I mean, it's going in there and buying massive opportunities everywhere. There's just so much money out there right now. It's stupid.
And I think people with all the COVID and all the money that's gone out there, people are wondering how we're going to pay for that and if inflation is going to take off. I was talking to an investor last week, and I was just telling him, man, I can sleep at night with real estate because I don't have to worry about some big, huge dip in the market or in crypto or something like that. And I tell them literally, I think to myself, my real estate goes up every single day. Now, maybe it's 0.01% or 0.15, I don't know what it is, but it goes up literally every day. And I don't have to worry about a big dip. I mean, we don't invest necessarily in these, something like a New York skyscraper or something that really could go down in value quite a bit. But anyway, so I just love the stability of it.
Yeah, absolutely. One of my favorite things is cash on cash. And cash on cash is simply stated, the cash you get every year in distributions. So like we send out quarterly checks. So if you take the quarterly checks and add them all up and you divide that by how much you invested originally in that investment, that's your cash on cash. That yields a percentage. And we're typically shooting like 12%. And getting 12% in cash every quarter. I mean, we even kept up our dividends in COVID. I mean, paying out every single quarter. And that's...
We put a couple properties on hold for a quarter or two, but now pretty much every property that we have, we're back online giving distributions. And at 12%, I mean, the market is at all-time highs. It's not going to continue to do even 12%, but we're paying you in cash 12%.
Yeah.
And so you can go reinvest that. Plus you're reducing your risk by getting more money in your pocket. But that's not your only return. I mean, you're literally making 20% a year compounding on that money. We just give you 12% a year back in your pocket.
Yeah.
Yeah, and we're going in, in underwriting. We're typically underwriting fairly modest rent growth. You pull up CoStar, you pull up the database of information in your market, and you can see what neighborhood and surrounding rents are, and you can get a feel for that. But they're typically horrible. They're typically really low. They're typically on the safe end. You can typically get a lot more if you're buying in good areas with good growth. Those stats just haven't shown yet. And I mean, sometimes you can get these properties where it works with just 2-3% annual income growth, but you could be getting 4 or 5 times that because of how under market they could be. We're looking at a deal right now, and I think the cap rate, on the building is a little aggressive, but on the back end, I'm looking at it and the rents are just so low. It makes me feel so good about it because, you can underwrite it with just normal market assumptions that make everyone feel safe and that are easily achievable, but you can easily get, a lot higher rent escalations. And then the returns get stupid. Those 12% returns could turn into whatever.
Yeah. Our latest deal, outside of St. Louis, Missouri, I underwrote 3 or 4% rent growth. The rents are drastically under market. It's funny. We just closed last week. My CFO brought me a renewal lease, and we're already going to propose to the tenant that's wanting a 5-year renewal. We're already going to propose an 8% year one, and then 4% a year after that.
Oh my gosh.
So in 5 years, we'll be 35% higher on rent. And I didn't underwrite that. That's the upside of doing these types of deals. And
it would be risky to underwrite that. Nobody wants you to underwrite that.
They don't want me to underwrite that. So what I'm doing is delivering really solid returns with conservative underwriting. And people will say, oh, you're not really going to get 30% across the board on your property. But the thing is, we have done it. We have properties right now where we've done it. Our Village South property here, it's a 100,000 square foot retail center here. Across the board, we're up 20-30%. And so what was underwritten at a 12% cash on cash, this next quarter, July 1, we'll be paying 25%.
Wow.
That's insane.
And by the end of the year, we may be paying 30%. And remember, that's the return to the investor.
That's just operational cash flow.
That's after our split. We're splitting the cash flow, and we're taking 25% and we're giving the investor 75%, and the 75% of the cash flow is still 30%.
Wow.
And so literally they could have their money back in 3 years. Of course, we've been delivering those returns now for 5 years. So most of them have close to their money back already.
Yeah.
So I just think if people have money sitting in an account making zero, or they have all of their money, let's say in the market, hoping to get a 9% compounded return, they need to get some of it in real estate where they can get 12% in their pocket, not just in an account.
Not including the appreciation, the paying down the debt.
Yeah. I mean, there's so many ways the tax leverages with real estate.
Yeah.
I just don't think people realize how powerful it is. Once again, there's risks. But I was talking to an investor today. With the way we underwrite deals, the chance that we overperform given our conservative underwriting versus having a couple tenants leave and underperforming it's way higher that we overperform. And Brian, you can speak to that because you've done a ton of deals with us. We've overperformed on most.
Yeah. Generally, they've overperformed rather than underperformed.
But let me make an important point here on the structure of how we syndicate. So let's say a tenant does move out and it underperforms. Okay, who takes the hit? The syndicator takes the first hit because we're paying an 8 pref. Yeah. Mm-hmm. So let's say I'm going to pay a 12% cash on cash. I pay 8% to the investor, and then I split the remaining cash flow, some percentage, to get the investor to 12. So let's say the deal level cash flow is 15. Mm-hmm. Okay. Well, so if we don't hit 15 and we only hit, let's say 11, the investor gets the first 8.
First 8's protected.
And then they get, let's say, 2/3 of that other 3%. So the investor goes to 10. I go to 0 as the syndicator, and the investor goes from 12 to 10.
Yeah,
okay?
I don't think people understand that. I'm glad you
I just want to make sure.
said that.
So we can take a huge hit in cash flow, and the sponsor takes the brunt of that hit, and the investor takes very little hit because they get the first 8% of all of the cash flow. Mm-hmm. Once again, I think that's a great benefit to investing in real estate and doing it this way, is that even if the deal doesn't perform, it has to drastically underperform for you to really take a hit on that cash flow.
Yeah, that's a good point.
Yeah, we had an interesting deal. We had that same example. It was during COVID, and at the end of the first quarter, most people were operating right along with their business plan. Then at the end of March hits, it's like a bomb. Nobody wants to do distributions after that. So we just said, hey, let's put a pin in this. Let's see how the next quarter goes. And everything seemed out to be okay, and we handled well, and we didn't suck up all of that cash, and we still had it. So the way our operating agreement read is that we evaluated that 8% preferred return quarterly. So since we didn't distribute it in the first quarter, that technically the second quarter, it was lost from the first quarter. But that wasn't fair. We literally just deferred it in our essence. So, I mean, we gave the investors the full 8% preferred return out, and who got hit on that deal was us. Mm-hmm. Because the first 8% always goes to the limited partner, and we're getting in front of people, and people are actually, asking the nitty gritty and really trying to wrap their heads around on how they're getting paid and what they're investing in and how the entity structure is set up and, just everything. When we can actually explain it, and when I feel like they actually understand it, that's typically when they're like, yeah, this is awesome, and then they do the first deal, they do the second deal, they get some checks, and they're like, wow, this is true. This is actually happening. I didn't get scammed. And then it just keeps going. And then before you know it, you've just got this relationship, like Duck. You guys have been investing together for so long because it's such a good asset class to invest in, and it's real.
There's a lot of great investments out there, but I bet that most people don't have investments where they get mailed a check every quarter.
Yeah, I don't.
Sometimes people invest in stuff, and then 2 or 3 years, 5 years later, it does really well for them. So I'm not saying there's not great investments that aren't real estate.
Yeah.
But I'm just saying it's my sole income right now is my invested dollars. Or I wouldn't say sole, but most of my income comes from my invested dollars.
Yeah.
And me getting distributions at the end of every quarter. And that money
that's close to passive income as you can get.
That's right.
Yeah, that's fantastic. Let me ask you guys about inflation, because there's a lot of talk about inflation, and typically inflation is bad for the stock market. And the reason is because your certificate of deposit is going to go up. So people think, well, I can be more secure and I can just go make my 3 or 4% in a CD now. And I don't have to take a chance on the stock market. Plus they think that a lot of businesses' costs are going to go up. So that's worse for the stock market and for these businesses. So their earnings are going to go down. What about commercial real estate? Are you guys able to keep up with, let's say if inflation goes up, can you charge more for rent? And also, does the value of your commercial real estate go up because inflation is going up? Can you guys talk about that just a little bit?
Hit it, man.
Yeah, it's a great point. So if you just get a salary, let's say you make $50,000 to $70,000 a year, $100,000, whatever you make, typically that salary is not going to keep up when inflation starts to run.
Yeah, it's going to be 2 or 3%.
That's right. And so what inflation does, it eats away at the value of the dollar, and your buying power is less because costs of goods are going up and you're getting a salary.
Yeah, easiest way to explain it is if you had $5,000 in 1970, it could buy you a fridge. If you kept that $5,000 in if you had $5,000 in 1970, it would buy you a car. But if you put that $5,000 in a bank today, it would buy you a fridge.
Yeah. Basically. And so how you hedge against inflation is to have assets, because assets will go up in value because just by nature the dollar is losing value.
Mm-hmm. Correct.
And so how we hedge against inflation in property is we raise rents. So every year, if inflation is higher, we up rents, which increases the value of that asset over time.
Yeah.
And it just makes sense because the more dollars are in circulation, the less the dollar is worth, the more people are willing to pay for income producing assets.
Yeah.
Yeah, that and replacement cost is another thing you can look at. A lot of the times you can buy great assets for cheaper than it costs to go build a new one where you can get comparable rents. So if I can go buy an older center for $100 a square foot, I know that I can't buy we bought a center in Broken Arrow, it's around $100 a square foot. There's a brand new shopping center being built right next to it, and it's probably several $100s per square foot. I would 100% much rather be in on my deal than that deal, just from a risk standpoint.
So that's a good point. It's automatically pushing prices up. We're trying to build an apartment complex right now, and costs are astronomical. So the more it costs to build new,
yes,
the more people will be willing to pay for something that's older.
Yep.
Correct.
So maybe it cost 20 years ago, it cost $80,000 to build an apartment complex. Well, now it costs $130,000, $140,000. And so people are willing. That's what's pushing all these older prices up, is because it costs so much to buy new. They're coming down and wanting to get something a little less.
Well, the next thing is kind of debt and tenuring in properties. A lot of people flip houses, and the biggest growth inhibitor to flipping houses is you run out of lenders. People stop kind of giving you money. You kind of stop being able to collect the houses because they write the loans differently. Commercial loans, you can just get typically better and more loans, and your risk from their perspective, the lender, which is why they're willing to give you more loan dollars, is because it's getting less risky every single year. The rents are typically going up. The principal balance on the loan is typically going down. It's proven in really fast, and then they're lending us the dollars because it's an investment. So over that few years, you're really gonna tenure that out.
Yeah.
Well, I think that was a pretty good segment. We encourage you guys, if you don't have money in real estate, get some of your portfolio in real estate. If you want to learn more about how the metrics work, cash on cash, internal rate of return, all of that, hit us up on email, hit us up on the website.
Absolutely. Thanks. We'll see you next time.
Thanks.